Howdy and welcome to Barrel Hitch Trading. This is Foundations, episode 4. And it's about maximizing survival, existence over returns and rate of return. What I'm going to talk about today is something called Sharpe Ratio, and I didn't have a clue what it is when I started trading. It popped up when I asked for some statistics from the internet and from other sources, and it popped up along with Kelly as ones that I hadn't heard of before. But Sharpe Ratio is not a bragging metric, it's a mirror. And it's common to see Sharpe as a ratio that tells how good a trader is. How well am I performing? But that's not what it does. It tells me how stable my decision making is under uncertainty. It tells me if I can withstand market structure and time. What Sharpe tells me makes it one of the most honest self-measuring sticks possible. The math behind it is simple. It's average return minus the risk-free rate divided by volatility of returns. But the important part about Sharpe Ratio isn't the math. It asks one question. How much return did I get per unit of chaos that I accepted? It doesn't tell me total profit or win rate or my biggest day. It doesn't cherry pick. It doesn't put lipstick on a pig, as it were. What it does tell me is return per variability. That's it. The mistake sometimes made looking at Sharpe is treating it like a ranking system. But it's not for comparing myself to other traders or hedge funds or any other system out there. What it is for comparing is me to myself yesterday or to the standard that I set for myself. It's there to compare the quality of the results of my equation, which is EV of system times EV of me. See, it doesn't care about P&L. Two traders can have the same P&L, 2 months, 2 weeks, 2 trades, but be qualitatively different. One curve can be smooth, repeatable, boring, or even the internals of one trade, while the other is violent, emotional, and fragile. Sharpe doesn't care about story. Talking about the cherry picking, the braggadocio. What Sharpe cares about is stability, repeatability. It cares about distribution of outcomes. And that is where Sharpe becomes powerful for those of us who are exuberantly, ruthlessly self-evaluating. Small accounts should not optimize for raw return, in my opinion. The ideal optimization focuses on survival, repeatability, and discipline under tight constraints. A trader risking 10% nominal per position, and any of you that have followed along, that should sound very familiar because it's the rule that I use for myself. But a 10% nominal per position risk with strict controls will often show, as it does with me, lower raw returns, suppressed compounding on purpose. Yes, I just said lower returns on purpose, by choice. Why? Higher structural integrity. Another way that traders have probably heard that if they've self-reflected at all on their results in their system is risk of ruin. You see, Sharpe rewards lower raw returns, suppressed compounding by choice in favor of higher structural integrity. If Sharpe is rising while absolute returns look boring or smaller, that's not a failure. That's foundational strength forming. Survivability. How Sharpe becomes a mirror instead of a trophy is important because I can always ask, did Sharpe go up when I followed my rules? Did Sharpe drop when I sized up emotionally? If I did, that doesn't happen to be a particular weakness of mine. Did Sharpe worsen when I chased? Or did it stabilize after adding, in my case recently, theta time stops or other execution constraints, as I've also added recently based on self-evaluation? Sharpe doesn't lie. It captures my hesitation, my overconfidence, any revenge trades, and impulse sizing, variability in execution. And it does that even if my P&L doesn't show it yet. So this is the line I'm trying to burn into my own memory, and that I hope you do as well, is I am attempting to trade like someone who expects to still be here trading. I'll let that sink in for a bit. I am not trying to ring the bell today. I'm trying to make sure I still have the hammer in my hand to ring the bell 5 years, 10 years, 15 years, 20 years, generationally out into the future. High Sharpe strategies don't look impressive early. There's almost never going to be a day that someone is going to look at my trading, or I'm going to look at my trading, and my eyes will pop. My results on my account size won't look impressive early, and it won't explode my account upward or downward. But what it will do, if I keep my Sharpe high, is scale cleanly, not just the way most of us think early on, which is in size, but also in time. Is it repeatable? Is it understandable? Is it transferable between instruments? I do expect to be here in the future. Ideally, I expect to outgrow IWM 1DTE at the money options. The only way that happens is a high Sharpe that has scaled in size and time. And if I do that, what I can do is survive regime changes in the market, because I do trade the shape, not the story. And that is what Sharpe quietly measures, is over time, will I still be here to even compound at all? It's not about being better than others. It's about becoming smoother, calmer, more predictable under pressure. If my Sharpe is rising, it means that I'm building something that can carry the load. And if it's falling, it means the market is telling me exactly where my structure is leaking, and to go back and be ruthless in my self-evaluation. I need to listen to the Sharpe ratio, because it is the translation of what the market structure reality is telling me about EV of system and EV of me. Know the shape, tie the hitch, check the splice, carry the load. Barrel hitch trading, journal only.